We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Lawrence Lepard from Equity Management Associates. Larry, thanks for joining me today.
Great to be with you again, Tom. I always enjoy our conversations.
Me too, Larry. And of course, there's never a lack of things to talk about.
That's for sure.
But I want to start today's discussion by giving you a little bit of a stat I saw this morning. And that was adjusted for inflation. Many metrics that Americans would care about, let's say, like the price of a home, their wage, car prices, food prices, you name it, are all more expensive than they were in the 30s. So are we in a depression without the headline grabbing market crash?
Well, that's a great point and great question. Yeah, I mean, as we all know, all the government statistics are fishy and they're all semi-cooked. And yeah, one could argue that on a real basis, the economy hasn't grown since 2008. I've seen some good data that supports that argument. I think that's what you're kind of alluding to. I mean, the inflation numbers, as I see them, hide a lot of inflation. I think we all know that. Shadow government stats shows that. And if you're looking at growth, real nominal reported growth of a lot of companies, okay, they grew 3% last year, they grew 5% last year. But if inflation was actually 9%, as then you and I both know, the real growth was slower. And the real growth is measured not in the dollar price that they sell at, but the number of units they sell. And I mean, you can see this in automobile sales, a lot of areas where there really hasn't been a lot of unit growth in a lot of things. And so yeah, and I think the other thing that you alluded to is just house prices are more expensive on a relative basis, relative to wages today than they used to be in the past. I mean, I think that's a function of the fact that the money is no good. And so, and the wage earners are getting screwed because the money is no good. So, yeah, it's a sad situation, Tom. I mean, it really is a sad situation. It's why we need sound money.
Mm-hmm. Larry, how do you think valuations got to the levels that we now see in the stock market that by traditional valuation metrics just don't make any sense?
Yeah, well, that's an easy one. You throw me a fat pitch. It's very simple. As we all know, well, I'll say there are a couple of legs to the stool. One of them is the Fed has created a put, and it goes all the way back to '87 and that crash, and when Greenspan started the plunge protection team, and the Fed has pretty consistently since that time communicated that they're not going to let anything bad happen to the market or the economy for a long period of time. In other words, and when it does, they're going to reduce interest rates to drive a growing credit cycle. So by keeping the cost of money too low for all of these years, it's driven what I call kind of multiple carry trades, where people borrow cheap and then they invest in assets that are going to grow. And so you've got the U.S. economy is kind of one big carry trade. So that's stool leg number one. I would say leg number two is zero interest rate policy, which supports leg number one. I mean, when we have downturns, as the first one was 2000, that bubble burst. They didn't go to zero then. They went. Greenspan took it to 1%, but 1% and Greenspan saying, "Hey, take out a HELOC." Well, guess what? That created the housing bubble, and then, of course, the housing bubble burst and we went to ZIRP, which is really unprecedented. They took interest rates literally to zero. And it lasted a long time. It lasted from '08 to 15. And then they brought it back in 19 and lasted all the way through COVID. So that's a long period of free money. And when money is free, what people will do, rational people will do, businesses, individuals, wealthy folks, et cetera, is they'll borrow cheap and they'll put it into an asset that yields 5, 10, 15, 20%. And that's why, you can get rich if you're a financial operator, what we kind of call quintillionaires, which named after the guy in the 1600, basically said the people who get the money first do better. So that's, leg number two. I would say leg number three is QE and just more money sloshing around. I mean, the Fed balance sheet, pre the great financial crisis was $900 billion. At the peak of COVID, it was $9 trillion, now coming back into seven-ish. But the point is, that's a lot of money that's been added to the system. The money's got to go somewhere. And so that excess money chases returns in the stock market, and that's why stock market is at levels that are really unprecedented, as you say. I mean, Dr. John Husband does great work on this. It's free and it's on his site. I mean, the stock market right now is more overvalued than the stock market was in 1929. And following 1929, when that bubble burst, top to bottom, that market went down 89%. And more recently, Husband calculates that just to get back into what he calls the band of fair valuation on multiples, et cetera, the market would need to fall by 65%. So that's a long way down from where we are right now. So, I watch a lot of my boomer cohorts saying, "Oh, the stock market's great. They've got, they've got all their retirement money in the stock market." And I try to warn them that, that it's been working. I get it, but it's potentially an accident waiting to happen. And I think at these kinds of valuations, that's a very, very risky strategy. Particularly since related point, Tom, and we've discussed this in the past. I think the 40-year trend of deflation is changing. From 80 when Volcker raised rates and got the deflationary trend started. We went down to a 30-year bond that was in the ones and twos during the COVID crisis, and of course now it's going back up rather sharply because inflation is back, and I don't think that we've got the inflation problem in the can. I mean, I think the market and the Fed are trying to tell everybody, don't worry, it's okay. We're going to go back to that deflationary stuff that you guys loved for 40 years. That's coming back again. But I think they're missing something that's important, which is there's been a really big change that occurred at COVID, where all the fiscal stimulus, all the QE, the pressure on labor, et cetera. I mean, it's once inflation breaks out, it's very hard to control it. The 70s showed us this, right?
Mm-hmm.
You had 3 waves of inflation, and you're seeing labor contracts are getting done at much higher rates year over year. And the reason is because you can't make it on today's wage, basically. And so, this is why you've had so many threatened strikes, and this is why you've seen people getting, 10, 15, 20% annual increases in their pay, because, I mean, when COVID came along, they printed 42%. They grew the money supply, M2, the broad one, 42%. And that was just like kind of devaluing everybody's savings by a similar amount. I mean, wow, that was really bad.
Mm-hmm.
So that to me, and so because people's savings are getting devalued, what do? They chase, everybody's I mean, we all know the money's going bad. And so everybody's in kind of and this is what happened in Weimar, everybody's in kind of a wild chase to try and grow their purchasing power, because they know that the expenses that they incur are going up every year relentlessly. And so you have to kind of chase yield. And, the stock market, I mean, the Mag 7 have worked, NVIDIA has worked, Apple has worked, the NASDAQ has worked. And so, you go right back to it, and you just assume it's going to keep working. And it will until it doesn't. And, your next question is going to be, when is it going to be it doesn't? And the answer is, I have no clue. Mm-hmm. I thought it would burst this year, and it may burst next year. It may not. They may keep it going. I mean, but I will say this, if they keep it going, it will be at the cost of inflation. The only way to keep it going is to keep pumping liquidity into the system, and that liquidity will inflate prices. Mm-hmm. Full stop. So, I think that's an important thing. So, which is why, what I advise my clients to do is you've got to have inflation protection insurance. You got to own things that can't print. Mm-hmm. And that's gold and silver and Bitcoin. So, that's kind of, it's a long-winded answer to your question, but I guess I covered a few topics you probably were going to cover anyway. So,
all good, Larry. But, you brought up kind of the point of what I wanted to get at in that question. And that's really, let's say, the Mag 7, especially, NVIDIA, Apple, these companies are trading at such high multiples of future profit or future earnings. Yeah. What do you think drove those, so many people and so much capital into those names, and that small concentration as well?
Well, there is some legitimacy, just like with, the dot-com bubble. I mean, these aren't all it's not fraud. These aren't all fake. I mean, AI is a real thing, and AI needs a lot of chips, and, and Bitcoin mining is a real thing, and Bitcoin mining needs a lot of chips. And these kinds of things drive, fantastic revenue growth in NVIDIA. I mean, let's not kid ourselves. I mean, this is a real company making really needed products. And so, and Apple, I mean, it's ubiquitous. I mean, some people have the alternative, but Apple has kind of owned, this ecosystem of their phone and all the other things that in the apps and all the other things that attach to it. So, these are really good businesses, almost bordering on monopolies. So it's not like this figure, but the question is, that one has to ask is, what does one pay for a really good business? And if you get to the point where the implied earnings yield gets down into the less than 1% range, well, if for any reason they suddenly become slightly less really good businesses, that multiple and that premium that you're paying for being with them can really kind of evaporate. And I'm not suggesting you short these companies. And I'm not even necessarily suggesting you sell all of these, all of your holdings of these companies. What I am suggesting, though, is that I do know people who have all of their net worth in these kinds of companies and in the NASDAQ and so on and so forth. And I know that, history says that the risk of that is fairly substantial because, things change. And, I mean, I use ChatGPT. I love it. It's essential to me. But the amount of capital that's gone into AI is just mind-boggling, and there's just no way that all of that capital can earn a good return. I mean, AI can't grow fast enough to support all the capital that's gone into it. So, and this was, I mean, the amount of capital that went into the internet, which I benefited from because I was an internet investor, in the 95 to 2000 period was mind-bending, but it got overheated and the bubble burst and look at, and the internet kept growing. It was a very good place to put capital. It made a ton of sense, but things can get ahead of themselves, I guess the point I'm trying to make. And when they do, then any little change in the landscape, tighter liquidity, whatever it might be, you can see 30 or 40% of the value of your stock get wiped out really quickly. So I hope that kind of answers your question or helps you on that. But that's how I see it.
Larry, you mentioned liquidity and how that is really driving the stock market. Do you think that that is basically the only story that we need to be paying attention to at this point to understand why these names and the market has been working the way it has?
Well, I think it's a big part of it. I mean, I must say, I confess to not fully understanding how the stuff is done as well as it's done because the Fed isn't, they're still conducting a small amount of quantitative tightening. It's only 25 billion a month, not the 60 they were at before. But there are a lot of different mechanisms that liquidity gets created through them, and the carry trade and so on and so forth. But I think there's another related issue, Tom, that that's worth focusing on, and that's how the liquidity affects the bond market and what the government spending is, because those are the other pieces of the equation. I mean, I think part of the reason why, I mean, as you recall, when Powell went on his big tightening campaign in early 2022, we lost more wealth more quickly than ever in the history of mankind. I mean, the stock market took a huge hickey, bond market took a huge hickey, et cetera. And, we kind of thought, all right, this is it. We're in the bear market. But when he in 23, when the bond market backed up on him and he said, okay, the rate hiking cycle is over, then, everybody came back into it. And the related thing that's happened and is important to watch, and I watch it carefully, and we'll talk about the election in a minute, is U.S. federal government spending. So I think it's an interesting data point that pre-COVID, the U.S. federal government was spending in the mid 4 trillion range, 4.2, 4.3, something like that. COVID came along and the spending went up to 6.5. So they really, in a very short period of time, they spent like $5 trillion over 2 years. This is the PPP and, the stimmies and all the stuff they did. And so they really ramped government spending. It went up as a percentage of GDP and everything else. And one would have thought, okay, so they ramped it. One would have thought, okay, COVID's over. It's going to come back down, right? But it didn't. They kept it up there. They just kept on going. And, the present administration, trying to save their ass, kept spending on everything, forgiving student loans, sending money to Ukraine, you name it. Of course, it didn't work, but they were trying to preserve their hides in the election. And government spending this year ended September 30, just came in at 6.75. I think the peak COVID year was like 7. So we haven't really, COVID grew the government, and they haven't backed off. And in fact, the other thing you see, if you forensically dig into the U.S. employment numbers, they've been okay. Unemployment it's started to tick up, but not as much as you would think. But a lot of the new job ads are at the government level, and that reflects that government, that excessive government spending. So, all of that kind of, they force fed the market, the economy to just kind of keep it running. But to me, it's a little bit of a zombie economy. And the other thing that happened is very meaningful, I think, is a lot of people suffered with inflation, which is horrible. And so their cost of living went up, and their income didn't go up commensurately, and they've been financing that with credit cards. And so there's a great chart floating around the internet. You just Google, credit card debt, and I mean it's amazing. I mean, people have just grown their credit card debt a lot to support their lifestyle. You can do that for a while, but eventually the minimum payments and the interest eat you alive.
Mhm.
And it appears that we're kind of reaching the point where that's going on. So I foresee that this economy is going to roll over. But since I've been wrong about that for a while, I don't even trust myself with great certainty to know that it'll happen now. I mean, I do notice though that employment, slowly but surely, unemployment's ticking up, auto delinquencies are ticking up, credit card delinquencies are ticking up. All those kinds of things are signals to me that maybe we're going to have a downturn here, an economic downturn. And really, I guess well, I'll leave it at that, and then figure out where you want to go next.
Well, you brought up one of the points that I did want to cover with you, and that's the bond market. Do you think that
Yeah,
ends up really being the canary in the coal mine that
it
makes it
is.
tougher
Yeah,
for the US government to keep operating at such high deficit levels?
yeah, that's absolutely, and it's one of the things I watch the most carefully, right? And this is because we've talked about this before, you and I, but this is because of the debt doom loop. And the debt doom loop is very simply defined as, the government's running a big deficit. They need to finance the deficit by selling bonds. They sell the bonds, and all other things being equal, same amount of supply, more supply, same demand. Interest rates have to go higher to get them sold. Interest rates going higher, of course, the U.S. government's the biggest debtor in the world, means that the U.S. government interest expense goes higher. And another scary chart, and this is actually in the book that I'm writing, and it's all over the internet as well, is just U.S. federal government interest expense. I mean, in the past 4 or 5 years, it's gone from 200 or 300 billion a year to well over 1.1 or 1.2 trillion
Mhm.
a year. So, so the interest expense gets larger, and that makes the deficit larger. That means they got to sell more bonds, and you can see where I'm going with this. It's wash, rinse, repeat. It's a deficit doom loop. And so I think eventually, and we saw it in September of 23 when the long bond or the 10-year got up into the fives, Fed came out and said, whoa, 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 this rate hiking cycle's over. I don't think the US and the world can live with a 5% 10-year. It's not there now. It's in the mid to low fours. So we've got a little bit of cushion. But I think at some point in time, if we keep running these deficits, the bond market's going to react and say, no more, no mas. I mean, we're not, and that'll also coincide with higher inflation prints. I mean, one thing that kept the bond market intact or doing okay is the peak of COVID inflation was 9. Well, now it's back down to 3. It's not, depends on what you look at, but round numbers. The target's 2, but I think what they're saying is, well, it's good enough for government work. 3 is okay. And, okay, fine. But what happens when 3 becomes 4? Which I think it will. If 3 becomes 4, then the bond market reacts and bonds go up through the 5. Then where I think we go here is the government will be forced to institute yield curve control. And to describe what that is, it means the government has to buy their own bonds in order to prevent the rate at which they're being issued at from going up. And one might say, how do they buy their own bonds? And they do it through quantitative easing, which is really expanding the Fed's balance sheet, which is taking another level. It's really just mouse click money. I mean, they're literally just on a mouse clicking it and saying, debit this amount into this bank's account. We're just going to make this new money out there, and we're going to use it to buy these bonds to keep interest rates low. The problem with that is that that's the kind of thing that leads to inflation. And when everybody can see that, I mean, we map out what's going to happen from here going forward. I think what's going to happen is the bond market's going to start to fail. Interest rates are going to start going up. The Fed is going to have to react because the economy cannot handle higher interest rates. And they're going to have to go back to, QE and, maybe even drop interest rates to a zero interest rate policy. That's the other thing that's going on. Very interesting, right? The United States used to finance a lot of its debt longer term, 5, 10, 20 year. If you look at the trend is that they're financing a lot more of their debt short term. And that actually corresponds with what happens in countries that have sovereign debt crises. They go to the short-term bill market because there's not really a lot of demand. I mean, there aren't a lot of people who want to take, the risk, the 20-year risk on a 20-year bond, that inflation is not going to be higher. So they go and they sell short bonds. Well, if short interest rates are 4 or 5%, and that's part of what drove, the interest cost up, that's problematic because it's going to get, interest expense will get bigger and bigger. But if the Fed says, oh, no, we're going to take rates back down to 1%, well, guess what? They just cut the cost of their own borrowing. The federal government's borrowing substantially. And so that will help in a sense, ironically. I mean, it's printing money, but it will help from the deficit standpoint because the federal interest costs will be lower on those shorter term bonds. So I think that's where they have to go. And, and what I call is, I think the next one is what I'm calling the big print. And I think when the big print comes, when people, they lose the fantasy that they're going to be able to get the things back under control and get back into that 40-year deflationary environment. When that fantasy explodes, our stuff is going to explode. Sound money is going to explode because everybody's going to go, oh my God, they can just never solve this problem. And therefore I've got to protect myself. So I see that coming. And I put the time window on that from as soon as tomorrow to, no more than 2 years out. And I think probably next year, just kind of looking based on all the data points I'm looking at. But, it's very hard to handicap the timing on these things, Tom. But the underlying math, it just is. I mean, the interest costs are there. They're going up. The deficits are there. They're going up. Now, I don't know if you want to go next into the kind of the U.S. election because, there's the whole Doge effort, and we could talk about that. I mean, some are saying, well, don't worry, Elon and Vivek are going to figure out a way to take $2 trillion out of the U.S. budget. You can't do it. I applaud the effort, and I don't doubt they'll be able to reduce some of the excess spending. But the notion that they can reduce the $2 trillion deficit to zero, it's just a fantasy. There's just no way. And we can dive into the numbers if you want. I explain why, but it's just a fantasy. So.
Well, I think part of it is that it's, I've had a couple conversations around that. It's notoriously difficult to get rid of any government employees. And by the time you do, that runway is at least a year out if you cut everybody on day one, right?
Correct. And that's right. And what they're looking at is the 20% of the government that's not in what I call the big four. So let's examine the big four. The big four are Social Security, truly a third rail, but they probably are going to have to touch it at some point because it's killing them.
Mm-hmm.
Medicare, which is related to Social Security, another kind of third rail, that they're not going to want to touch. Interest costs, we talked about that earlier, which they can actually address. If they take interest rates down, their interest costs will fall. And then the fourth one is defense, which, arguably, if they're able to broker a peace in Ukraine and stop sending money there and so on and so forth, perhaps the defense budget can shrink a bit. But defense is $900 billion. But I think it is notoriously hard to cut these expenses. And they're going to have, a great difficulty. And so the balance, the $1.3 trillion that's not in those big four categories. Even if you go whack that 30%, you're only saving $280 billion a year. Last year we had a deficit of 1.8 trillion. Last year ended September. And if you look at the last 6 months of last year, the run rate was closer to 2.4. So, they take it down by 400, even five. Let's say they get 500 billion out of the deficit, which would be really doing out of the budget, which would be a hell of a job, by the way. Applaud them if they can do that. You still got a $2 trillion deficit. You know what I mean? It's not the notion that we take the deficit to zero. It's just, it's sadly, it's so far gone here. We're just really way down we're like the family with 10 credit cards and we just can't make the minimum payments unless we get a new credit card. You know what I mean? A new credit line. It's that bad. Mm-hmm. It's unfortunate.
Well, Larry, right in that vein, I think is an interesting point to make here. Yeah. And that's the idea that, Trump wants a lower dollar. And if we do end up making the big print, as you call it, and slashing interest rates, does that end up, achieving that aim of having a weaker dollar to be able to export easier?
Yeah, I think it does. And honestly, we need a lower dollar so badly. I mean, if we want to reshore our industry, if we want to be competitive, if, I mean, just everything about it. But the funny thing is, I mean, and don't get me wrong, I'm very glad that the party that won. But Trump's a lot of contradictions. And, he wants a stronger dollar, but realistically, a stronger dollar isn't going to help us. We actually have to have a weaker dollar. He wants to do 100% tariffs. I mean, that's a negotiating standpoint. I don't think that makes a lot of sense, and that's, by the way, very inflationary and would, turn down the world economy in general. Um, yeah, I think as a practical matter, the way we've got to get out of this is, and the way people, and this is a debt crisis, it's a sovereign debt crisis. I mean, Ray Dalio has a great book on these. Highly recommend everyone read it. And these have happened many times before, and it's not unusual, right? And there are a couple of ways. I mean, you just default on the debt, say we're not going to pay it at all, we're going to go bankrupt. That's kind of that's a mess. That's really bad. That's not going to happen. But generally speaking, the way that you get out of these things is you have high inflation for a while. You run really, really high inflation. Maybe even you have an economic downturn, and then after that, then you clamp down on the money supply, and hopefully, you return to sound money and some kind of a reset. I mean, that's kind of the best case scenario as I see it. But yeah, pushing for a sound dollar is not going to help the problem, the fundamental problem. We actually need a weaker dollar. It's also interesting. I mean, they're talking about doing a strategic Bitcoin reserve, and everyone says that be good for the country and so on and so forth. And I don't disagree with that, but that's not good for the dollar. I mean, Bitcoin and gold are the two signals, they're the canaries in the coal mine that the dollar isn't working. And that's the other thing. I mean, I mean, somebody asked me the other day, well, hang on a second, Larry, how do we really know we're in this crisis, that we're at kind of the end game, and that the dollar is got problems, and the US economy, that the whole, that we're truly in a sovereign debt crisis? I say, I know, I'll tell you exactly how you know. Go look at the charts of gold and Bitcoin. They're both at record highs. And then do a ratio chart of gold compared to the long bond. In the last 3 years, it's up 170%. Or Bitcoin compared to the long bond. In the last 3 years, it's up to 3,000%. And so these are forms of money that the government can't print. And what I believe is we are in a monetary failure event. I mean, maybe early days could, take 5 to 10 years to unwind, but we're well along the way to a sovereign debt crisis. And as I say, these have been seen before. We've studied these, Tom. We've seen Argentina go through this. We've seen Brazil go through this. We've seen Venezuela go through this. We've seen other countries do the same things. And we shouldn't expect that the outcome will be different for us just because we're the reserve currency. It may take longer, and we may be able to do a reset. I mean, we may be able to figure a better way out than they all did. But, if we continue, I mean, the only way we really get this under control is just massive cuts in government spending and entitlements. I mean, 30% cut in defense, 30% cut in all the Social Security and Medicare might get us going back in the right direction, but those things are pretty unlikely. So that's to me. I mean, that's one of the ways out. And by the way, if you did those things, you would have one hell of a recession. Do you know what I mean? Which, I mean, that's the other thing. It's kind of amazing. Just I'll add as a side point here. We're running these deficits in a territory where the stock market's at record levels and unemployment is relatively under control, although ticking up slowly. So, imagine, and in the last two big crises, 2000 and 2008, when the stock market goes down 50%, as it did in both those crises, tax receipts fall, expenses go up, you get more unemployment insurance, and everything blows out. And so, I mean, imagine what's going to happen in the next crises. I mean, if something breaks, the stock market breaks, it's this deficit thing is going to get bigger. And what I'm alluding to is what many people know, and I know, is called Gresham's law. And so we're in a slow currency failure event, which I think could become, slowly but suddenly, it could become a sudden currency failure event. And when it becomes a sudden currency failure event, that'll happen when everybody realizes. If you read the history of all these hyperinflations, they happen when everybody realizes they can never stop printing money. I mean, right now, there are a lot of people, some of us realize that. I realize that. I think you do. A lot of the listeners here probably do too. But the vast majority of the population doesn't realize that. But I think, if each of these monetary printing events comes faster and faster and gets larger and larger, very much the way it did in all these other hyperinflations I've studied, then eventually what happens is the entire world concludes, shit, they're going to just print this thing till it's worthless. So I better get out of it right now.
Mhm.
I gotta, I'm not storing. I mean, yeah, you use the dollar to pay for things because that's what everybody uses. But boy, you wouldn't store any wealth there. And at the extreme in Weimar Germany, in the last days of their currency failure, they were marking prices up every hour, and people would get paid, and they'd rush to buy something real because they knew that it would cost more in a day. So. And we're not anywhere close to that. And I'm not saying we're going to go there. It would take a lot of terrible policies to get to something that awful. But the point is, we're drifting very steadily in that direction. And so ergo, the reason I wrote this book is I just wanted I say in the book, I want to get up on the top of, a soapbox and scream, guys, we got a currency failure event going on here. Pay attention.
Mhm.
You got to protect yourself. So that's kind of, that's what I've been focused on trying to explain to people, in the last 6 months.
As you kind of mentioned, Larry, we're in this a bit of a trough for inflation here. And if you
Yeah.
look at the inflation chart from the 70s, it kind of has three big peaks
Yep.
to it.
Great chart. Yeah.
And we've so far we've matched it fairly evenly.
Yeah.
Do you think that we are in that trough, and that, the big print creates that next huge and more consequential and destructive wave of inflation here?
That's exactly what I think, Tom. And by the way, the trough could go on for a little bit longer. I mean,
Mhm.
housing's a big component of the inflation statistic. And I was just in New Orleans. I was on a panel with Danielle Martino Booth, and she used to work at the Fed. She follows it very carefully. She knows quite well. And she said the housing numbers are finally really starting to soften up, and that's going to help the inflation. They're going to get some good inflation prints here for a while. So look, the trough could last a while, but the markets for sound money are forward looking. I mean, people aren't buying gold, because of what inflation is going to print next month. They're buying gold because they know that in a year or two, the government's going to be forced to print a lot of money. I
Mhm.
mean, that's why it broke out from 2070 in March. And I would say, to somewhat to the same degree, the same is true with Bitcoin, although it's got kind of a speculative NASDAQ-y kind of, portion of the demand there. But, but yeah, it's the next wave will come when the next downturn occurs and the big print and maybe all the stimmies come with it. Now, I mean, I would say this: it would have occurred more and faster if the blue team had won in this election, because I think that the red team actually does sincerely want to try to get things back on the right path and balance the budget. I think the math is such it's going to be extremely hard, if not impossible. But, I mean, can you imagine, let's say Kamala had won, think of the horror of that. Uh, can you imagine what she would have been? I mean, Stephanie Kelton, maybe MMT woman as Treasury Secretary. I mean, I mean, look, they've kind of the Democrats have kind of indicated that they will spend and do whatever they think they have to do to keep the economy growing. We'd be back in another round of stimmies. I mean, we'd have guys like Andrew Yang talking about universal basic income, and of course, how do you pay for these things? Well, there's only one way to pay for them, and that's to print the money and create inflation.
Mhm.
So yeah, I mean, it's that next wave up is coming, but again, I caution everybody. I mean, it's hard, it's frustrating. It's been a couple of years, and gold stocks been terrible 3 years. It could. I'm hoping that's changing. I think it is. Kind of feels like it is, but I don't know. I mean, I could be wrong. It could take another year or two, but I don't think the math is wrong. And I don't think I do think a lot of people are hopeful that we're back into this deflationary trend, and hopeful that Trump and his Doge committee can balance the budget, and hopeful that therefore we'll have a strong dollar and everything will be good. But I don't think that's really what the math suggests. If you look at the math carefully, those are hopes. They're not kind of the hard cold numbers.
Mhm. Larry, where do you think we end up in that next big print, in real assets or hard
Yeah,
assets like
so
gold and
that's a great
Bitcoin?
question. It depends a lot on how it unfolds and how
Mhm.
severe they consider it to be. But I think when they have to when the bond market, if and when the bond market fails, and I think that's coming, it's a big market. It's 36 trillion, and eventually, if the Fed goes to yield curve control, so all these bondholders are like, what do you mean you're locking me in at 3%? I'm not holding this shit for 3%. Sold to you, right? So the Fed balance sheet, which is 7 trillion, I mean, add the 36. I'm not suggesting that would happen, but I think the next round, I mean, we went from 900 to 4, and then we went back down a little bit, and then we went from 4 to 9, and now we've come back down a little bit. And I think the next one we're going to go from 7 to 25. You know what I mean? And I think the price of gold isn't going to be in the same zip code. I mean, I think we're going to be at $4, $5, $6, $7,000 gold, and I think the prices of Bitcoin is not going to be in the same zip code. We're going to be at 200 to $500,000 Bitcoin. So it's there's a lot of upside in these alternative money assets, store of value money assets that can't be printed. So yeah, but as always, Tom, they will try to deny that there's a problem. They will say they're never going to print again. They will, they're right now nothing's broken, so they can, they've kind of got it papered over and everything's okay. But under the surface, you can see the problems starting to, emerge, and they will, I think, become more and more prominent. And then at some point, something really big will break, and we'll be right back in it again. And they'll do what they did in the past. They'll say, we have to do this, or else the system would collapse. And yeah, it's probably going to be inflationary, but that's better than the alternative, which is the Great Depression. That's always been the argument, and I think they'll use it again. So,
Larry, one thing that's been pointed to, especially as we're talking about the bond market here, is the growth of Bitcoin market cap alongside Tether as well. It's been pointed to that it is an important, let's say, additional vector to sell treasuries into. So do you think that, just reinforces that argument of Bitcoin and some cryptos mopping up some of that excess liquidity?
Yeah, let's define these things. I mean, for those who don't know, Tether's a stable coin, so it's basically a $1 coin that people can trade on, or USDT is the same thing, but you can trade it on the Bitcoin network, which some people want to do. And Tether holds, by the way, Tether holds some gold, which I thought was very interesting. But Tether holds, treasury bonds, short-term treasury bills to back it. So when you and it's a very profitable company, by the way. You put your money in these short-term treasury bills, and they use it to buy Bitcoin. So yeah, I mean, right now the Tether demand for Bitcoin is still a very small sliver of the total Bitcoin demand, but as this trend, that could change, right? I mean, as Bitcoin becomes higher priced and as more people use stable coins, well, then Tether's going to become bigger, and they're going to be a bigger buyer of treasury bonds or treasury bills, and that's going to help the government finance its deficits. And so arguably, this whole Bitcoin eco-structure growth provides, one piece of a puzzle for helping the government to finance their deficits. And look, there's some people who've called for a strategic Bitcoin reserve and at much higher Bitcoin prices. I mean, the government owns 210,000 Bitcoin, although there was some evidence yesterday they were thinking about selling some. I sure hope they don't. But that at a much higher price, Bitcoin could kind of quote unquote, somebody used the word defease the U.S. government debt, and I think that's possibly true. I think the important thing here, Tom, is that the government, the countries, the world, the world needs to move to sounder currency, because the Keynesian currencies that we've got, with the levers and the Fed and the central banks that we've got, they kind of reach the end of the road, and we're all kind of losing faith in them. And they're trapped in that problem of like being a drunk and using alcohol to cure every hangover, and each hangover is worse, and so you got to use more alcohol and and the solution is just to go cold turkey, and you have a hell of a hangover, but you get sober again, stay there, which I would define as we're on a sound money system now, gold-backed currency or Bitcoin-backed currency. Then you don't have the credit growth and the boom bust problems that this Keynesian Federal Reserve system has created for us. That problem will go away. And that's, I see that day coming. I have little doubt that that's how the world will evolve. Again, the timing is tough, right? I thought it was coming in 2008, and here we are 16 years later. So, you and I'll be having this conversation probably in 5 years. I think it's going to happen in 5 years, but I'll probably be wrong. It could take longer. So,
Larry, I think the phrase "take Trump seriously but not literally" is a great way to frame the current
yeah,
statements coming out of the president-elect. So, what do you think is a good example of where we should apply this framework?
it's a great question. I haven't thought much about it. I mean, I take it seriously that he actually really does care about making the country a better place. I really do take that very seriously. I think he wants to see America be, restored to its prior glory. Um, I think his notion of how to do that is kind of constantly evolving, a little bit scattershot and not always well thought out. But I'm very pleased that I think his advisors in this cycle are better than his. I think he learned something in the first cycle. The deep state kind of got him. Fauci fooled him. He had some neocons in the War Department, Pompeo and others. And I think he learned something from that. And I'm pleased that there are some people who have more libertarian leanings around him. I mean, I consider Tulsi Gabbard to be kind of a libertarian. She was a Democrat, now a Republican, now an independent. I consider Robert Kennedy to be a bit of a libertarian. I even consider Elon to be a bit of a libertarian. So, I think, and he did not rehire some of those neocons for the defense position so far. So, I think that he is trending in the right direction, but honestly, he doesn't entirely get it. I mean, just to give you an example, in crypto world, we all, those of us who are in it, believe in Bitcoin and really don't believe in all the other cryptos. They're kind of a lot of noise and nonsense. I think there's a lot of shit coins is what we call them. I mean, the first thing he does, he gets into crypto and his son goes out and creates, Trump coin, and tries to sell a bunch of coins. It does a pump and dump. And I'm just like, dude, what are you thinking? Yeah, you're right. Bitcoin's a good thing, but why are you creating your own coin and trying to get rich off it? So, look, nobody's perfect and everybody's got flaws. And I mean, and by definition, all politicians have tons of flaws. But I think, in terms of the direction of the country, I would much rather have somebody who leans libertarian and leans individual liberty and freedom running it than the blue crew who, from all I can see, they want to, really go the other direction on that stuff. I mean, from Elizabeth Warren to, well, all of them, really, they're horrible. So, now, is Red Team going to get it all right? No, no way. They'll probably get a lot of things wrong. But I'm much more Red Team leaning than Blue Team leaning. Because I'm fundamentally a classical liberal or a libertarian. So.
Larry, what do you think explains the relative underperformance of the miners, both in the Bitcoin realm and the gold world? This seems to apply to both camps. And for those investors that were seeking more leverage to the upside of both of these assets, really has been a disappointment. So what do you think explains those similarities?
It sure has. It's been terrible. It's a slightly different answer for both things. I'll take the gold miners first because that's probably more of your audience, and that's my biggest fund position is my gold mining fund. And I've said this many times, but just to repeat, gold mining is a spread business, right? There's the price of gold, and then there's the cost to pull it out of the ground. And the cost to pull it out of the ground is called the all-in sustaining cost, which is pulling it out plus, maintaining that level of production. ASICs, all-in sustaining costs, have kind of crept up consistently over the years, and that's driven by higher oil prices and so on, inputs. Right now, the average ASIC across the industry is about $1,400 an ounce to pull gold out of the ground. When gold was at 27 or 2070, you had, I don't know, $670 of profit per ounce. Now it's at 2,600. You've got really nice profits per ounce that you're pulling out of the ground, 1,200. And the industry is, the well-run companies are quite profitable. Okay, but let's step deeper into that. That ASIC number, Tom, goes up every year with inflation. I mean, it went up a lot during COVID. It went up 15% a year. Now it's kind of going up more closer to maybe 5 to 9% a year. So the gold price needs to go up at least that amount, or else gold miner margins are shrinking. Well, here's the interesting piece. Here's where I think people have it wrong. Just like in the stock market, where people are kind of looking backwards, if you go on to Bloomberg and you look at kind of consensus gold price estimates for the year 2029, which is 5 years from now, everyone thinks in 5 years we're going to have a gold price of, well, the average, I think, consensus estimate is about $2,100. So right now we're at $2,650 on the price of gold. And people are saying in the future they think it'll go down. The average consensus estimate is 2,100. So they're saying that the price of gold is going to go down $500 over the next 5 years, because they're thinking this is kind of a one-time bump, and inflation will go away and we'll land the plane, everything will be good. The earlier narrative, deflation, right? Um, meanwhile, you've got, and of course it doesn't entirely flip, but meanwhile, you've got ASICs going up, and of course, how you have gold coming down because inflation is going down, but you have inflation in ASICs, that's not logical, but still ASICs are going up. And so I think what people are doing is they're saying, well, we're going to have higher ASICs and we're not going to have a higher selling price. The margins are going to shrink. I don't want to own these stocks. They suck. The error in all that logic is, in my view, what's going to happen is the price of gold is not going to stop at 2,500. It's going to go much, much higher over time. And in 2,900, it could be 4,000, 5,000, 6,000. It'll be at least 3,500. And, the ASICs won't go up that much, such that they'll still be good margins. So I think that accounts for what's going on in the gold miners. The Bitcoin miners, I'm also involved in a fund that does a lot of Bitcoin stuff. Bitcoin miners is a slightly different case. What's happened there is that there's just been, as you know, the Bitcoin miners, the revenue they get is a combination of fees, but the mining reward for every block that they successfully produce. That block reward is obviously dependent on the price of Bitcoin. So higher Bitcoin price, bigger cash reward. The cost is the electricity of running the machines to try to solve the problem, to try and win that reward. The problem that's going on, and the issue is that people can add capacity, which is called hash rate, by buying new machines and adding them to the network. And I think the thing that surprised everybody there, including myself, is that the global hash rate has just been relentlessly climbing. And so because there are no barriers to entry, anyone can buy a machine, plug it into the network, and mine for Bitcoin. What used to be, and the rewards get divided kind of proportionally across all of the machines mining. So if you're in there mining, you'll get your fair share, especially if you're in a big pool. But your fair share is going to be, divided by everyone else who's mining, and so it's going to be a smaller reward. And so what it translates, because the difficulty adjustment goes up. There are a lot of other things going on here, but the point is that the math and the economics of the Bitcoin mining business have turned out to be much tougher than a lot of people thought, as a result of a lot of people adding global hash rate. And some of that global hash rate is being added from stranded energy. And that's a very interesting thing. I've heard, it used to be the case that you could make good money mining Bitcoin if your energy cost was 7, 8, 9 cents a kilowatt hour. Well, that's long gone. 7, 8, 9, 6, 7, 8, 9, that's a non-starter. You can't make any money with a mining operation at those prices. You've got to be at least at 5, and you don't make much there. You really got to be at 4, 3, 2, or 1. So this is pennies per kilowatt hour. So, and what we're finding is people are actually finding sources of stranded energy, like a river in the middle of nowhere with a lot of hydropower, or flare gas in the middle of nowhere with a lot of energy that you can get from that flare gas, and then they're using that power to run a mining operation, which can it downloads the data from a satellite, and so they might be mining at a penny or two per kilowatt hour, and so they can actually make money. But what that does, that makes the hash bigger, and so bottom line, I'm not a big fan of the Bitcoin mining investment space in general. I think it's always going to be confronted with this issue. But I am a big fan of the gold mining space, because it's hard to find and build a gold mine. And if you've got a good gold mine that's going to run for many, many years, that really is a cash generating machine. Just to give you a sense, to touch on the numbers here for a moment, Tom. Typical math historically is that when gold goes up 10%, the miners go up 30%. That's kind of the rule of thumb. This year, what you see, I think year to date, gold's up 25, say maybe 30%, and the miners are up similar. So there's been no leverage. Owning the miners, you're better off, or equal advantage this year to own gold versus owning the miners. But I think that's going to change. And what's going to drive that change? What's going to drive that change is the knowledge that gold is going a lot higher. The other thing that affects all the gold space is, again, back to our comments earlier on the stock market, and those of us in the gold market can see it. Gold's doing pretty well, actually. Up 25% this year and making new all-time highs. But it's really, in our view, the party really hasn't gotten started yet. And the reason is, a lot of the party goers are over at the other party. They're doing the Mag 7 and the stock market party, and they're having fun, and it's working. And so they're kind of like, why do I need gold? Inflation's not a real thing. It's going to get solved. I don't need to be over there. Well, okay. Wait until the stock market doesn't start to work. Wait until we have a market peak and the economy really does turn down and the stock market starts turning down again. And, gold is still going up because inflation, and maybe that's all driven by inflation, by the way, because inflation isn't good for the stock market. And, so their accounts start going down as a result of the stock market not working, and gold stocks start going up. You're going to see an enormous amount of migration from them to us. And there's $120 trillion of stock market assets. I think Tavi Casa did the numbers. I think the total asset value of all the gold miners in the world is like less than, $1 billion. Or yeah, I think it's, I don't know if I have this right. It's like, it's small. Maybe I think it's less than $1 trillion. It's not very big compared to the total assets in dollars. Yeah, it's less than $1 trillion. So you got $120 trillion in general stocks, and you've got all the gold stocks in the world market caps are less than $1 trillion. I think maybe substantially less, like maybe 600 billion or something. Well, guess what? When that stuff starts to not work, they're going to look for what's working, and our stuff's going to be working. So we are, in my view, we are in a bull market for gold stocks. I mean, my fund's up 30% this year. It's not blowout, but it's solid. And I expect that as what I'm describing happens in here, the economy slows down, the stock market peaks, inflation starts to come back. We're sitting right in front of what will be a very good time to be a holder of gold stocks, and I'm quite convinced that my fund will go 100% one of these years. I mean, just to give you context, when the COVID thing came and they went crazy, the fund I managed 2019 fund went up 97% that year. The next year it went up 122%. So in 2 years it did 4x. So 400% in 2 years. And that's the hard part about this sector, is that you have these periods where it just is shitty and it underperforms, it goes down, you're just not making any money. But then when it becomes obvious that they're printing a ton of money and debasing the currency, it goes berserk, And if you're not there, by the way, you don't get to participate. I mean, I had somebody in 2019 or 2020, I started telling him in January, even before COVID, I said, this stuff's starting to work, you should buy it. He said, no, 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 no. And he watched it just go up massively. And then in August, right at the peak, he bought it. He came in, and that was, and it was too late. I mean, if 8 months and you missed more or less all of the 2020 gain. Mm-hmm. So, it's hard to do, but you actually have to be buying the stocks right now when they're still relatively cheap before they launch. If you chase them after they launch, you're setting yourself up for a bit of pain when the next correction comes. So just some context.
Larry, how do you think the gold demand picture coming out of China, the PBOC buying so much gold, how do you think that fits into this thesis as well?
It all helps. I mean, look, what we're seeing, and this is, it's big. I mean, it's not just China, it's Russia, it's the Middle East, it's, Turkey. I mean, there are a lot of countries, Poland, a lot of countries have been buying gold. This all fits into the thesis that the world needs a neutral reserve currency. We just do. And the dollar has proven that it's broken, and when we grabbed the Russian assets, that was just one more nail in the coffin of, why would I want to hold dollars? Mm-hmm. And, we're now seeing, I mean, the dollar trade used to be 95% of all trade in the world. It's down to 50, high 50s, low 60s. And we're now seeing, countries like China and Saudi Arabia and Russia and India, they're all trading with one another in their own currencies. And if for some reason one of the countries ends up with too much of the other country's currency that they don't need, fine, they just convert it into gold. Whereas in the past, they would have converted it into dollars. Mm-hmm. And the reason they're doing that is they just don't trust the dollar as much anymore. And they can look at our fiscal situation in the same way that we do. And they're like, hey, this isn't a good store of value anymore. I mean, the US stopped selling net positive amount of bonds overseas in 2014. I mean, and that's, the rest of the world has figured it out. And so there's a very strong bid underneath the gold price, and it comes from people who want to buy a neutral reserve asset that they know will probably play a big role in whatever kind of monetary day of reckoning or reset that we have, because it's played that role for 5,000 years. So yeah, it's all good. And to me, I said earlier in the interview, Tom, that's the tell. the tell that the dollar's in trouble and the tell that the U.S., that we're entering a sovereign debt crisis is the fact that gold and Bitcoin are both at record highs.
Mm-hmm.
That's the tell. And until something fundamental changes, we're going to climb a wall of worry. I know I've talked to a lot of people like, oh shit, you should sell this gold at 2650. It's up a huge amount. Well, no, from 2000 to 2011, gold went from 250 to 1900, the seven bagger. From 71 to 1980, gold went from 35 to 800 briefly, really went to 400, but 22x. I mean, when you get a gold bull market, when you get a legitimate gold bull market, you tend to get 5 to 7x, your base level. The base level for this particular gold bull market was $1,000 at the end of 2015. So 5 to 7x that is $5,000 to $7,000. We're halfway there. We're $2,500, $2,600 into it. Mm-hmm. So that probably makes sense to me. That's probably, at that point in time, look, it could go a whole lot higher if we have currency failure, but I'm also, I've been around this game, seen how it works long enough that I'm not going to be a pig. And if we get there, the miners are going to be multiples of where they are now, and I'll be lightening up. I mean, I'm not quite sure where I'll be putting it. I'll have to find something that's more attractive, but I think, it'd be time to lighten up because it won't be quite so obvious. The thesis that to me is quite obvious now will not be as obvious as these prices get higher.
Mm-hmm. Larry, another piece, let's say, of that thesis that really goes along with gold is the silver supply demand fundamental picture.
Yeah.
When do you think that actually starts to matter? Because we've spoken for years about this.
Oh man, silver's just breaking my heart. It's driving me nuts. It's just so friggin' hard. And I got a lot of silver personally. We got a lot of silver miners. So let's just talk about silver for a minute. There are a lot of things to understand. First of all, it's not gold. There's a lot more of it, and the stock to flow is a lot higher. We don't have a big stockpile of it, and the market value of it's much smaller. And that's why it's such a wild and crazy market. In a real precious metals bull market, silver goes up a lot faster, but it also comes down a lot faster. And but there are a lot of factors driving demand. One piece is the monetary piece. It's every man's gold. I mean, most people, a gold coin at 2650, not everyone can afford that. But a silver coin at $32, anyone can afford that. And it also has an industrial use, as we all know, and those industrial uses are really growing. I've seen data that shows or suggests that solar demand will be half of the silver production annually. It's presently closer to 20%. Not that far out, 5 years out. There's also a lot of data that suggests that it gets heavily used in electronics, electric cars, EVs, etc. And now there's some big Japanese companies developing solid state batteries that use a ton of silver, and they provide much higher range and quicker recharge than lithium-based batteries. And if those get developed and lead to demand for silver, that could shove it higher. And then there's investment demand. And as I say, I mean, I think we mine about $300 billion worth of gold every year. We mine about like $30 billion worth of silver. So if suddenly you got a lot of people coming and saying, I want some silver, it doesn't take much to tip the supply demand balance. And, it hasn't happened yet, but it's amazing to me. It's the one commodity that hasn't broken really its all-time peak. I mean, it's been at 50 twice, the Hunt brothers, and then 2011. And we haven't even gotten through 50 yet. And we will, and no doubt. And, I've seen projections that say it goes to 100. I've seen projections that say it goes to 500. I'm pretty comfortable we'll get to 100 in this cycle. I don't know about the 500, but that's all coming. But like so many things, it's just requiring enormous patience. And we've got a lot of people believing that stocks are the place to be. I mean, this stock market bubble, this is one for the history books. I mean, go back and read about 29. It's similar. It's really similar. It's a big, big, big bubble. But what somebody said something. The problem with bubbles and manias is you can either look stupid beforehand, where you won't participate, you're not in it, or you can look stupid afterhand, where you're in it, but then you don't get out in time and it collapses. I mean, and I prefer not to play, just because it's partially rigged, and the government has a lot of incentives to try and keep it going, and they're going to try. definitely going to try.
Larry, just because commodities are, let's say, historically cheap when compared to the S&P, does this mean that it's only a matter of time before this reversion to the mean
I
happens, or
totally
is it?
believe that. Yeah, there's a great Marin Katusa chart on that. And it shows that, yeah, right now they're as cheap as they've ever been, commodities. And and we're entering an inflationary period, which should be very, very good for commodities and very, very bad for stocks. So I think that's really the key question, Tom, is that it's got to become I think we're in the 70s. The market says no. The market thinks we're going to go back to, status quo, deflation, inflation's under control. We're not in the 70s. I disagree. If they're right, then I'm going to be wrong and this stuff's not going to work. If I'm right, then this stuff's going to work fabulously. And we're going to see. We need to turn over the cards. We need to turn over the inflation cards, the economy cards, the big print cards, to see what the government does, etc. I think mathematically, the government and the system can't operate without inflation. So I believe that we'll go there. But right now, it's as you say, it's come down, and people are kind of like, well, it's not great, but 3% is not horrible, and maybe it'll get back to 2, and we'll enter that deflationary world we were used to be in, and so on and so forth. I mean, it reminds me, I entered the investment business in the 80s. It reminds me a lot of that time. In that time, long bond was yielding like 13%. It was crazy, right? And stocks were like, you didn't want to buy stocks because you just come off the 70s. Stocks had done nothing. They've gone nowhere with a big bear market in 73. And you wanted to own gold, and you wanted to own oil. Why? Because they were the best performing assets for the entire decade of the 70s. And it was obvious. I mean, I remember it so clearly in the early 80s. People were like, well, inflation is going to be a problem forever. We are never going to solve inflation. It's going to last forever. And if you don't have a heavy allocation to gold and oil, you're nuts.
Mhm.
That was the consensus view. Okay. And of course, what happened? Gold went down, oil went down, and stocks did extraordinarily well, as they came out of that. And so right now, the consensus view is you got to be in the stock market. It's going to go on forever. We made a ton of money there. We're going to keep making money there. You don't need inflation protection. We're in a deflationary world, et cetera, et cetera. And it's hard. I mean, these changes don't occur very often. I mean, this is 40 years, 44 years from 80 to present, right? Or 50 years. No, 44 years. So yeah, and it's hard. I mean, and if I'm wrong, I'm wrong. I mean, if we go back to that deflationary world, well, then this is going to be a much tougher trade. And there is that possibility, but I don't see it. And the reason I don't see it is I don't see the government. I think the bond market and the government financial picture is what drives the tipping point. I think when we did COVID, we kind of broke the glass on deflation, and we're now just in a different environment. And that's kind of, that's why I take the view I take.
Excellent, Larry. Well, I appreciate you, expanding upon all of these different subjects for us, trying to bring some clarity to these different time periods and really studying this stuff so thoroughly. Is there anything that you'd like to leave our listeners to think about
Yeah, I
before we
would.
wrap
I'm
up?
just, I told you I was going to do this. I'm writing a book, and I want to plug it if I can.
Mhm.
And I'll just tell you the thesis, and I think it's an important topic, and I hope people will buy it, and then I hope they'll, not because I make money on it. It's surprising, you don't make very much money when you publish a book. The publisher takes all the money. But more importantly, I hope they'll pass it around, because I want us to return to sound money. The book is it's basically an examination of what's gone wrong and why the system is as broken as it's broken, which is really inflation and money printing since 71. Talks about all the wealth inequality, etc. Talks about the Federal Reserve and the actions they took and how we got here, and then proposes how we solve this. It's
Mhm.
very optimistic. Like, a lot of good things are going on. I mean, the internet is deflationary, Bitcoin is deflationary. There are a lot of good and positive things that are taking place, that I think will make the world a better place. I mean, I point to the internet as being, decentralization is coming, and decentralization. The world got broken by centralization and big corrupt centralized organizations doing the wrong things, like the Fed and the federal government starting wars. And the good news is, you and I are talking here from far apart, over the internet with video, and this can happen with people anywhere in the world. And everyone knows CNN lies, and everyone knows you get a better source of information out of guys like you or Joe Rogan or Tucker Carlson. And so, people aren't buying the narrative anymore. more as more and more join our ranks, we're going to force the system to be fairer and based on sound money. And so that's what the book is about. It talks about how and why we got here, and then what we got to do to get us to, a better system, so that my kids and your kids and my grandkids, hopefully someday, don't have to deal with these issues ever again. The Federal Reserve will be gone. So that's the topic of the book. And again, I tout it because I want a lot of people to read it. Because I think if we really want to get this change, have this change take place, this needs to become a topic that everyone is aware of and everyone is, pushing for, and so that the politicians, start to take the steps they need to take to make things better. Mm-hmm. So that's the point of the book.
What's the title going to be, Larry?
I'm not going to tell you. You're going to like it.
Okay.
I'm holding the title secret because it's a really cool title, and when I announce it, everyone will get it. So it's coming out. It's coming out in February. I'm done with it. It's being edited now. It goes to the publisher at the end of this month, and so that means it would probably be on Amazon in February. It's kind of the current thinking.
Excellent. Well, we'll have to you back on to.
Yeah, I hope to come back on when I do it after you've read it and take a look, see what you think.
100%. Larry, thanks so much for your time today. Of course, for anybody that wants to view or read more of Larry's work, all available at EMA2, where they do their quarterly reports, EMA2.com. And as well, excellent Twitter follow at Lawrence Lepard. Larry, thanks so much.
Thanks a lot, Tom. Always enjoyed talking to you.
Same.
Have a good holiday.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.